Splendid. Councillor Westman, chair is yours.
Nice. Hey, thank you, everyone. And thank you, Mr. Mayor, for sharing that so effectively. Okay. Item number 2, appointment of vice chair. I'd like to propose that Councillor Romans is appointed vice chair. Seconder, Councillor Plant, it looks like. Yep. Any other nominations? All those in favour? Okay, thank you. Apologies for absence, Town Clerk.
We have apologies from Councillor Councillor Romans and Councillor Hostings.
Declarations of interest. No declarations of interest relating to the business of the meeting. Public participation. Do we have any public participation? And bearing in mind that you're coming up next in item 6, but you are theoretically welcome to speak. Yeah, you've got anything? No, okay. Item number 6, investment manager reports. So I'd like to invite our investment managers to approach the table, to take a seat and come and give their reports and answer any questions that the councillors may have. Right. Okay, so would you like to first of all just introduce who you are, and you can toss a coin to see who goes first.
I'm Nick McGregor from Redmayne Bentley in Henley. This is my colleague Jasmine Saxford.
Jasmine, no. Welcome. Well, I think we've seen you here before.
Yes, I came last year,
I
but I
thought
sat
so.
quietly in the back.
I made the mistake of offering me helpful feedback after I left, at which point I said, fine, in that case, you can do some of the next.
Yeah.
Here we are.
Charles Heaton from Investec.
Right, welcome and thank you for coming. It's good to hear your views and listen to your reports. So, have you decided between you who's going to go first? I don't mind.
I think you went last time, Nick. Shall I kick off this time?
Entirely up to you.
That seems a very sensible way of doing it.
My apologies for the idiot that stated these the wrong way round. So, and that was me. My apologies also that I failed to read the instructions from Sheridan, who asked for the report to go to the end of March, and I have run it to the 30th of April. I haven't referenced the 30th of March within the text of the performance, so my apologies for failing on several counts. Anyway, turning to the first page, long-term performance, as usual, going back as far as we can to 31st of August 2012 to 30th of April 24. Portfolio value, top left quadrant, standing at 1.812 million and producing an income of £79,366. And in the right-hand side, the net total return over this period of 104.1%, which equates to 6.31% per annum over this period. The benchmark, of course, is a measure of inflation. So consumer price inflation plus 4%. So it's a pretty tough benchmark to get anywhere near, which I think we've referred to in the past, Nick, haven't we? And maybe worth considering reviewing whether that is the appropriate benchmark in the future. That benchmark has produced a return of 147%, which is just over 8% per annum. Perhaps more interestingly, what is the peer group, how they've performed, and that's measured by Asset Risk Consultants, who is an independent agency that collates information from about 120 investment firms around the city, and Nick's firm will certainly be one of them. And using a risk measure called the Balanced Asset Index. That has returned 61% over this period, which equates to 4.16% per annum, or the variant of that, a slightly higher degree of risk, the Steady Growth Index, that's produced 87.2%, 5.52% per annum. It's difficult to know which of those those indices your portfolio naturally sits. We think it sits in the balanced asset category. ARC thinks that it's now in the steady growth category, which we've referred to in the previous year. This partly is a function of us moving more assets overseas, and we have maintained the exposure under the 45% limitation, which you imposed upon us, I think, 4 or possibly 5 years ago. The charts, the bar charts and the line charts, I think, are self-explanatory and explain the performance over this period. What is very noticeable is how the performance in 2022, the recovery phase as we came out of the COVID period, was very, very poor for your portfolio, and then we've made reasonably solid gains in 23 and a reasonable recovery in 2024. It's interesting to note that the portfolio, if we valued it at last night's close, would be at 1.87 million, so quite an increase since this valuation report was drawn up at the end of April. The bottom left-hand quadrant, I think, is instructive in that it breaks down the different asset allocation within your portfolio. So you've got 63.5% in equities, the maximum that we're permitted to go to with the mandate for the level of risk that you're prepared to take, which is a medium degree of risk, is 67.5%. So we're slightly below the maximum amount of equities, and the fixed income element, i.e. bonds, is running at 18.7%. And as you can see, there's a very clear differential in the performance over this long period between the returns from fixed interest securities and equities, which clearly have been the superior provider of performance over this period. We've comfortably outperformed the UK benchmark with a return of 151% compared with 119%. Conversely, we have not done so well in overseas equities, and overseas equities have been dominated very much by the US market, which now accounts for 62% of the world index. And as we go further into the report, I'll highlight why we would not be able to get the representation overseas that we might like, partly because of the 45% limit, but also because of your need for income. Those markets overseas simply do not produce enough income. And I'll come on to give you some examples of what I'm talking about. The remaining balance of the assets are in property and alternative assets. And by alternatives, we mean things that in theory are not correlated with equities. The reality is they've been more correlated than we had thought, and the performance has been very similar to the bond markets over this longer period. Nevertheless, they give you a yield premium over fixed interest securities. So these are total return figures over this long period. Turning over the page, we then come back to the now. So in the year to 30th of April, as I say, the non-sterling assets limit 45% of the portfolio is currently at 39% in overseas markets. We have adhered to your restrictions on no oil and gas, no mining, no tobacco, no gambling, no chemicals. And again, it may be worth at some point reviewing that criteria, those restrictions, to see if they still prevail. but we have excluded those. If you strip those different sectors out of the performance, it has a marginal effect. As you can see, the all share, if you strip those things out, it makes a marginal difference to the performance, which is shown in the table. I've also referred, as I say, to the performance to the end of, excuse me, to the end of March, where your portfolio has returned 6.9% in the year, and the benchmark is up 7.79%. And then the ARC figures similarly are presented there. The interesting thing yet again is how fixed interest securities in this period this year have underperformed equities really sharply, and how strongly the US market has performed, which is driven essentially by technology, which the UK market has virtually no exposure to. You may have read in the press about the Magnificent Seven and the dominance of those 7 major stocks, which have performed incredibly strongly due to artificial intelligence and all that that brings to the party. And we'll look at some examples of where you have had exposure to those stocks on the next page. As I mentioned earlier, the property assets and infrastructure funds, which are predominantly designed to produce income, they have performed very badly in this period. Why is that the case? Because interest rates remain high, and the way one values those businesses is based on discounted cash flow and net asset values, and that has been very much against this sector while interest rates are running at 5.5%. So they have performed in capital terms very badly, but they have delivered forward in terms of income. Turning over the page, we just look in chart form at some of the sectors that are excluded, and you can see in this period of the year how strongly the mining stocks have performed, how strongly oil and gas have performed, both giving returns of over 14%, which compares to virtually twice the rate of return of the all share index. On the other hand, 2 other sectors that we're banned from, chemicals and tobacco, have performed pretty poorly. I would be unlikely to invest in tobacco anyway, even if I were permitted to. Chemicals, possibly. So I think the impact of not investing in mining stocks and oil and gas is very pronounced. And the biggest impact really was in 22, post the Ukraine invasion, where those sectors performed very strongly. But even in 23, it's had quite a pronounced impact on the performance for your portfolio. So what's done well and what's done badly in this year to the end of April? Unfortunately, it's a lot of the clean energy businesses. So things like SDCL, energy efficiency, who install solar power, wind power, and try and make businesses much more emission efficient, underperform significantly. Global Clean Energy ETF tracking fund down 27% in this period. HICL Infrastructure, again exposed to renewable energy. The Renewable Energy Infrastructure Fund down 13%. So our ways of capturing returns from new energy has I'm afraid, been counterproductive in this period, whereas we've seen that old dirty energy really performed strongly in this period. The other areas that have performed badly have been, as I say, the infrastructure funds and property to some extent, which is reflected in this table. Conversely, what has performed very well, and that's been the high growth stocks. And you can see the range of names in here. Polarcap Technology Fund, self-explanatory, up 50% in this year. HD Capital Trust, probably the second largest software business in Europe, but wrapped up within a trust structure, up nearly 40%. Finley Park American Fund, again, dominated by technology. The Polar Capital Artificial Intelligence Fund, again, pretty obvious from its title where it's exposed. There are UK companies that have clearly benefited from the whole AI excitement and fervor. Experian, which is the credit checking business, and RELX, which is basically a data crunching business that analyzes risk and analyzes both legal data and things like that, and clear beneficiaries of the whole AI areas of growth. But as I point out in the top part of the comment, these technology companies, very high growth, clearly have outperformed as have US assets. They would only have produced you £9,000 worth of income in this period. Our mandate is that we have to try and produce well over 60,000. We're currently producing just under 80,000. So much as they're producing the growth, they simply don't produce enough income for you. So as always, it's finding the right balance for the mandate that you've set us. Turning over the page, we've run the Sustainalytics ESG criteria that you asked us to do, I think, probably, I forget now, 4, possibly 5 years ago, I think. This only really screens for the UK investments. It doesn't screen for the collective funds because it's very hard to actually look through and find out exactly what they've got in their funds. But this gives you a flavour of how we can position the portfolio in the things we can buy. And as you can see, overall, your risk score for your portfolio is coming out at 18.4, somewhat below the UK benchmark, and in the risk category of low. And I think we have met your criteria, your mandate for investing in businesses that are high quality and score well on the ESG risk categories. If you look at the column where it's talking about 16 out of 137, 17 out of 76, 3 out of 76, they're all within their own industry sector, performing very well on the criteria that we measure. And there are probably, I think, 17 or maybe 20 different areas that are being assessed to see about their environmental, social and governance criteria. Turning over the page, sorry, boring economics lecture, but what we've seen over the last year, which will be very obvious to you, is rapidly rising inflation and then, thankfully, fairly rapidly declining inflation. That's reflected in the charts. Why did inflation go up? A combination of reasons. COVID, supply chains becoming sclerotic, and then the invasion of Ukraine, etc., etc. So this is almost entirely a supply side problem with inflation, not demand led, which is the usual reason why inflation goes up. And that's then reflected in the producer price inflation data in the right-hand chart, again, showing that it's dropping back to in many cases, many countries, to virtually zero, which is very encouraging, therefore, for consumer price inflation, which is the left-hand chart. What has been the impact on the investment markets? It's been mostly reflected in the fixed interest markets, and we've already said those markets have performed very poorly, and it's simply a function of yields in the UK rising from 1.9% 2 years ago to the current level of 4.1%. That is a very, very large shift in interest rates, which is reflected in these charts for bond yields. Exactly the same sort of thing in the US, with yields moving from 2.79 to 4.4% now. That is as dramatic a shift in interest rates as we have seen since the early 1980s, I think 81, or maybe it was 83, I forget the details now. And markets have had to cope with that big shift in interest rates. And it's mostly in the bond markets where the pain has been felt, which was reflected in the performance of those assets in your portfolio. So very quickly, moving on to look at the UK. Here we have a chart of the blue line showing inflation coming down very dramatically. We probably will hear, I think, is it tomorrow or Thursday, Nick? Inflation figures coming out tomorrow, isn't it? Coming out at somewhere near 2%-ish at the moment. The last print was at 3.23%, which is shown on the chart. And the key thing really here is to look at how real earnings in relation to that inflation are beginning to pick up. So people's disposable income is beginning to look relatively good in relation to that inflation. And as you know, economies are essentially driven by all of us consuming stuff. The UK, it's about 61%, much higher in the US, about 68% of any economic growth is driven by what we all do. And we probably should just be beginning to feel a little bit more prosperous as inflation comes down. Real inflation is beginning to come back into positive territory, and wage growth is typically around the 5.5%. There will still sadly be a lot of people in society who are struggling with the cost of living crisis, but the evidence is that it's beginning to work. As Rishi Sunak thought it would. Probably not quick enough to save him from losing the election, but that's another matter which we probably shouldn't discuss here.
Once we want to finish tonight.
So, as I said, if we turn over the page to the US, it's the consumer that's the important issue. So we've got very solid tailwinds for the US consumer. Personal income, again, comfortably above the rate of inflation, therefore people's disposable income holding up very well. Why is it holding up? Because employment is remaining robust in the US. As I said earlier, 68% of economic growth is made up of the consumer. Therefore, it's very important to know what is happening to the consumer in the US. A lot of people had thought the US was going into recession last year. Actually, it's been very robust. The US households' disposable income, their levels of debt are not a worry. The ability to service their debt service payments, not a problem. If you go back 15 years to 2008-9, that was a problem. That's why we had a deep, sharp recession in 2008-9. It's not an issue now. People have learned from those experiences. Savings, unbelievably, have been really rather strong. Yes, people have begun to eat into those savings in the last year or so, but savings are really pretty robust in the US. And as I said earlier, employment levels are pretty robust. So we don't feel there's going to be a recession in the US at all because of this data with consumers remaining pretty resilient. And if anything, economic growth may well be expanding. And hopefully, if we've got the right chart, if we go over to the next page, we've got some data on economic growth. The chart, the table on the left-hand side talks about how growth is beginning to accelerate around the world gradually from a fairly low level, and beginning to accelerate, we think, into 2025. And I think today we saw the IMF talking about accelerating growth in the UK from about 0.5% up to 0.7%. Now, if you remember, going back to August 22, before, and again, sorry to talk about politics, but before Liz Truss and Kwasi Kwarteng did their thing with unfunded fiscal expansion, the Bank of England was talking about a very severe, deep recession, and that was in August 22. And they thought that the recession in the UK would last for well over 3 years, and they were very, very pessimistic. Now, that might have been rhetoric to try and persuade people not to be too aggressive with their wage bargaining, but that analysis has proved to be very flawed, and the evidence is the UK economy is now beginning to accelerate. And as I say today, the IMF has just talked about raising their forecasts for this year to, I think, 0.7% from the current level of 0.5. So why are we confident? Well, we look at things like the Purchasing Managers Indices, so the top right chart, global composite PMI, clearly beginning to turn up. Anything over 50 is expansionary. That's encouraging for economic growth. Looking at the bottom table, it's all a bit jazzy and difficult to understand, but the key thing is the number of countries that are now in the top right quadrant expanding PMI data. Germany, Japan, EU generally, United Kingdom, Spain, etc., etc., etc. A lot of these countries are exhibiting growth after the relative weakness of 2023. There aren't many countries that are slipping back into contracting territory. So we think that perhaps we're at the start of a new business cycle. Some people will say we're at the tail end of the old one, but I think the evidence is we're near the beginning of a new business cycle where interest rates will be coming down because inflation's coming down, economic growth accelerating. What does that mean for investments? That's good for profits. And hopefully I've got a chart over the page, which if we turn to the top left table showing earnings growth for the major markets, for the UK, for the US, sorry, 10% or thereabouts earnings growth, corporate earnings growth, and accelerating up in 25 and 26. UK a little bit more anemic for 24 at 3.7%, Europe at 5.1%, but the trend is the important thing in it's going up and accelerating up in 25 and 26. And it's no surprise, as I was saying earlier, that your portfolio is now 60 or 70,000 pounds more than when at the end of March, for example. It's going up because stock market's going up because they can see these corporate earnings coming through pretty strongly and pretty robustly. Bottom left-hand graph, global earnings expectations, as this says. We should expect them to continue to rise. Stock markets like rising profits, earnings growth. Markets are quite expensive in the US. You've got to pay up for that growth. And that comes back to my table of what had performed well, technology, etc. So we can see the most expensive areas, not surprising, technology, but that's because it's delivering the greatest growth, the greatest return on the investment in capital employed in the bottom bottom right-hand chart. So again, it's finding the right balance for the portfolio of growth versus value versus income generation to keep the portfolio going up over time. I think we probably have got that one more chart economics lecture almost at the end. Second largest economy in the world, China. You might say, well, so what? But you know, it is a very large economy and it has a very big impact on what's happening in the world. China is in a sort of different business cycle. Its inflation is very, very low and has been for quite a while. So that implies that the Chinese authorities can lower interest rates to stimulate their economy, to get growth growing. At the moment, it's probably growing about 4.5%. It's not going to be growing as it did in the past 10 years of 7, 8, 9, 10%. Those days are over. But 4% growth is pretty reasonable. And the emphasis is shifting dramatically from investing in real estate, which is still proving a massive hangover for their economy. Real estate accounts for about 26% of economic growth, but of course it hasn't produced any economic growth. It's just been a dead weight. So that's the reason why the Chinese economy is struggling. But we're optimistic that going forwards, the authorities will gradually be able to get more growth coming out of that economy. And that's reflected in these charts on the right-hand side. Consumers spending more, industrial businesses, manufacturing, producing more, and economic growth coming from that area as the hangover from the property investment cycle begins to recede into the background. But it's a slow process, but we're optimistic that that is beginning to happen. And then finally, just my summary. Global growth is still quite muted at the moment, but there are signs, as we say, that it's beginning to accelerate. Interest rates will be coming down. I can't forecast when they'll come down in the UK, but the market thinks it's possibly July, maybe August in the US. Could be September, could be December. No one really knows. I mean, it keeps changing as we go through the year. But the trend is down in inflation. The trend is down in interest rates. That's positive for economic growth. That's positive for risk assets, equities, and the other assets that you've got in property and infrastructure. That's it.
Right, thank you, Charles. Thank you. We'll do questions, I think, on both presentations. So would you like to go ahead, make a gentleman who can speak?
To first of all, just touch on your stated objectives. It's important that we reiterate what we think we're doing and what we think the brief is. So you've asked us to provide income to meet day-to-day costs and budgeting costs within the council, to provide longer term growth in capital, to limit risk and volatility within your stated attitude to risk, which, as I say, a couple of years ago was amended from cautious to moderate. Your investment policy document states a maximum exposure of 70% in equities and 45% in non-sterling denominated assets. As Charles touched on, Sustainalytics criteria, we don't rate portfolios on Sustainalytics per se, but having had a look at what's there at the moment, I estimate that we'd score 22, which is fractionally higher than Charles's, although the only thing I would also highlight is the fact that there's a significant majority of the portfolio that Sustainalytics don't cover, as Charles said, in terms of overseas holdings, collectives, any funds, and so on. So it's a score on a minority element of the portfolio. And again, to reiterate that you preclude investment and in oil and gas, tobacco, chemicals, mining, and gambling. And so I think from that point of view, it meets all of those criteria. In terms of outcomes, the last time we sat here was January last year. And at that point, we'd had a rather better or less bad time of 2022 than Charles had. The nature of the assets and the sorts of assets mean that position's somewhat been reversed. 2023 for the first 9 months was pretty horrific, as we were holding a lot of those assets that were especially interest rate sensitive. Things like infrastructure funds and so on that price down when interest rates go up. We all knew interest rates were going up, The issue hasn't been that, it's been that they went rather higher than the 4.5% consensus forecast. And more importantly, almost than that, but they stayed higher for longer. From Q4 of last year, from about the end of September, as soon as the inflation data started to become much more benign, that position started reversing, the portfolio started moving in the right direction. And so far this year, that's continued, and the portfolio remains ahead of the relevant benchmark for 2024 to date. Also, since the last time we spoke, we've paid away about £278,000 between capital drawdowns and income to you. Normally, capital drawdowns have an impact on your income in terms of the residual amount of capital available to earn dividends. The forecast yield on the portfolio is pretty well held steady. It's at the same absolute amount of income as it was before that couple of £100,000 of capital drawdowns. The effect of that is effectively that the yield's gone from just under 3.6% to 4.06%, which sounds like bits of a percent. It's quite a hefty rise. That's down to a couple of things. That's down to rising dividends. And it's also down to the fact that areas where there was no capacity to generate an income previously, such as gilts and so on, have offered a genuine option for the first time in nearly a generation. But I think that it's worth pointing out that that yield, which off the top of my head won't now be, after years of it always being Charles earned the lion's share of the income, in absolute terms you do, but as a percentage, I think they'll both be somewhere between 4 and 4.25%, I'm guessing at the moment.
Yes.
It's worth bearing in mind that the FTSE yield's about 3.72% at the moment. The S&P yield's about 1.35% at the moment. And that's dependent on some of the biggest dividend payers in the market, which are oil companies, mining companies, tobacco companies, and so on. While Charles touched on the performance of the benchmarks of the indexes, if you take those things out, if you looked at the income of the indexes, if you take those things out, it magnifies that, and it's a much bigger gap. I would guess, I haven't done the calculation, but the FTSE yielding 3.72%. If you took out mining, oil companies, tobacco companies, and then try to blend the yield on the remainder, I would suggest it's probably not much more than 3%. So you are generating income at a significant level in excess of pretty well any equity-based benchmark. I would mention, in fairness, we have one holding in the portfolio that's currently suspended. We've marked it at 0 in your portfolio purely because the stock is not trading day to day, and so that's just a decision from our point of view about how we show it, rather than showing it at the last traded price prior to suspension. We, if we do a conservative look at its net asset value and expected value on return to a portfolio, it would add about another 0.8% to the value of your portfolio and to the performance. On page 5, there's a summary of your current income levels and so on, and distinct outcome over different periods. As I say, this year so far, for all of the reasons Charles touched on, which affect us as well, so I won't bore you by repeating them all, because I know you all have homes to go to. This year is starting to build some very nice momentum. In terms of the specifics of your portfolio and the asset allocation and changes we've made to positioning and so on, Jasmine's going to run through some of the decisions made and how we're trying to position things to make sure that the portfolio not only stays within your instructions, but also is exposed to the right sort of upside going forward.
Yes, so we have made a number of changes to the portfolio since we last met, in line with the wider macroeconomic environment, which Charles has obviously touched on, your recent drawdowns, and to continue our repositioning following your changing risk mandate. We moved away from our previously heavy weighting in alternatives amid their falling valuations and increasing interest rate sensitivity, and we increased our equity exposure. We made some direct purchases, for example, Bodycote, which was added off the back of strong announcements and share buybacks. We also added some more geographically spread top performing equity funds such as Brunner Investment Trust and Polar Capital Technology Trust, which Charles, you spoke about. Both allow us exposure to sectors and markets that are outperforming their peers without having to take a bet on one individual stock within the sector or market. We took profits from SSE at a share price high following a change in direction from the business as they continued to move from supplier to generator and then subsequently cut their dividend. Some of our other sales include Vodafone, BT, Gravis Digital Infrastructure and Sequoia. While their high yields were attractive, the companies had fallen out of favour with the markets, and a hold position just no longer benefited the portfolio in the long run. Even without these high dividend contributors, the overall portfolio income has been maintained, which Nick obviously mentioned earlier. We also raised our fixed interest exposure as short-term yields became attractive in the wake of rising interest rates, and we took opportunities to capitalise on this while locking in some secure returns going forward. As mentioned, these changes have been made in response to your drawdown requests, the economic outlook, and to continue the progression into a moderate risk portfolio. While the equity exposure has risen considerably, this is somewhat offset by a marked increase in fixed interest and a reduction from the more volatile alternatives that we were holding before. The overall portfolio volatility score for the portfolio is 8.61%, which is still comfortably under our upper limit of 14.5% for a moderate risk portfolio. We can see the extent of these changes reflected in the figures on page 7, which also shows that the investments remain well spread geographically and within the asset allocations. Equities have risen from 50.8% to 59.91%, which obviously still gives us a decent amount of room to that upper limit of 70%. And the geographic allocation is still heavily weighted to the UK, but most of that is global multinationals like Unilever that are listed on the London Stock Exchange, but actually make their money sort of all over the world. So it's not entirely UK income that we're dependent on there. I will.
Back market.
Yeah, if anyone's got any questions about obviously the asset allocation, ask them afterwards, but market commentary.
So as Charles said, the first quarter of 2024 has been pretty busy. Our market view doesn't differ enormously to that expressed by Charles. I think the thing that's that momentum that we've seen starting in 2024 fizzled a little bit in about late February, March, when people worried inflation wasn't going to keep coming down. But that seems to be back on the pace. Interestingly, it's not all winners are equal. The Magnificent Seven in America make up such a large percentage of the S&P. It's not across the board. Tesla and Apple have had a really pretty rough start to this year. It's easy to lose money in a rising market. Just pick the wrong ones, as it were, and you know, investors who bet heavily on the wrong tech stocks in America have found that to their cost. I think the interesting thing is that the UK has been out of favour for a long time in terms of valuations in global equities. Because something is cheap by one measure of value doesn't mean it's a good idea just to buy it, because things that are cheap can stay cheap. But what we're starting to see now is I think a change in that. The headline rises in things like the FTSE aren't the interesting bit, because that's primarily been driven by two things: oil prices and banks recover, because the FTSE is so heavily weighted in those. The interesting bit is the much broader move from UK companies through the mid-cap and large-cap sectors to buy back their own stock. They actually now see the best use of their spare money to buy their own shares because they think they're ridiculously cheap, and it's the best way to get money back to shareholders to effectively buy back their own stock, reduce the numbers of shares in issue, and increase the earnings attributable to each remaining share. And that's also starting to be seen in international perceptions. The amount of overseas takeover activity for UK listed businesses has started to tick up as overseas investors also take the view that UK PLC is fundamentally relatively cheap. Bond markets haven't done a huge amount. They did okay at the beginning of the year, faltered a bit, and have now started, they look relatively stable at the moment. The key thing for bond markets is interest rates. The key thing for alternatives and so on is interest rates. The IMF turned around today and said that they felt that the UK had room for 3 interest rate cuts this year. A while ago, the market consensus was for rate cuts. The average worked out about 0.7% at some point this year. And then suddenly that went into reverse as everyone thought inflation might be stickier and we may only get 1 or 2 small cuts. It seems like that tide is changing, and tomorrow's inflation figures should, prove the point. And I think will be seen as quite key because politically, both the Bank of England and the Chancellor would like to see rates come down. The number of MPC committee members who are now actually saying they can see rate cuts sooner rather than later is going up, despite the Governor of the Bank of England playing a relatively guarded hand and not saying when. Looking ahead, markets will remain very much focused on that. It's certainly the case that whether it's as quickly as markets would like, there is now no expectation that rates will stay at this level indefinitely, and absolutely no expectation that they will rise at the moment. The blue box on page 9 shows the IMF's growth projections by region. They're a little dated. They only put these out once in a while, and they have upgraded most areas recently. They recently, as Charles mentioned, bumped up their expectations for the UK. They've moderately raised their expectations for the US. And I think the interesting thing is that while growth on an overall basis at 3% and a bit globally is relatively steady rather than stellar, the fact that developed market economies are where the upgrades are coming is encouraging for investors. That is inevitably where most of your money and every other investor's money is focused. No matter how much emerging markets may be interesting, by nature of risk management, one ends up attributing a much smaller amount of money to them. I think the outlook from our point of view now, we probably feel far more comfortable than we have for the last couple of years. That is subject to change in terms of what might happen in the world and who might invade who and so on. But I think the big known issues are that if the Middle East doesn't escalate, sadly, the markets actually are quite sanguine about an element of geographical conflict in the Middle East. It happens and it doesn't phase the markets as long as it's not going to upset the oil price. It's harsh, but that's the way the markets view it. Politically, I don't think the markets are worried about a UK election. They'd be worried if they thought it was going to be close, because hung parliaments and uncertainty are bad for everybody thinks it's going to be close. And the markets aren't worried in the way they may have been in 2019, because I think the view is that a Keir Starmer Labour government will look like a Tony Blair Labour government, not a Jeremy Corbyn. So the markets will continue merely making money. The US election, very similarly, no matter what the bizarre foibles of Mr. Trump, he's seen as being good for business and good for capitalism and so on. So no matter what personal views one might have about the politics anywhere, elections here and pretty well everywhere else in the world, over half of the world's population will vote in a general election this year. And in almost every case, the market's not worried about it. And I think that removes one of the key, it all looks good now, but it might turn 6 months later issues. So I think from our point of view, we are just about taking our tin hat off now and looking at the future with a degree more optimism.
Okay, thank you. So what I'm going to do now, what we usually do is just ask councillors to go around the table and ask councillors got any questions. Don't feel you have to ask. I'd encourage councillors to try and keep the questions relevant to our rather parochial business that we're supposed to be considering here, rather than the what may be very interesting but isn't really well here to talk about, which is the world economy, except how it affects us. So, Lawrence, do you want to start?
Yeah, I asked it written down a few as I read through. Number one, I think we pretty much asked it to you each time. Was like, would there be obviously anything that you would be doing differently with a few of the percentages that we've got in our portfolios? Obviously, we increased the risk, but I see even at the risk we are now, we've still got potentially 5 or 6% that will put us towards the upper end of moderate anyway. So, just are there any key factors that you would like to potentially discuss with us changing? And that also looks, I guess, the 45% rule in sterling and the 70% rule as well. Like, are they overly prohibitive? Are they preventing us from certain areas? I guess the third question is with some of the drawdowns, obviously we've taken, would we be better looking at potential growth in the portfolio rather than actually taking dividends out to try and rebuild it? Or is that in conflict with what key targets are?
In terms of, I can only speak for our view, in terms of the 3 points you raise, the restrictions that you have are the restrictions that you have, and we'll work within them, and that's fine. Yes, outcomes might be different, and so on. But I think that you, as we said last time we were here, where it had sort of in that period cost money, because in the post-Russian invasion of Ukraine, oil prices had gone up, and well, it's cost you money having those policies this year, but in another period, it might work very much to your advantage, because it's, they're very concentrated sectors, things like mining and tobacco and oil and gas. There's not that many companies in them, so they tend to all do well or do bad. In terms of the more structural restrictions, like a maximum 70% on equities, we anyway, from a moderate point of view, portfolio point of view, would limit it that level anyway. Charles, I think
we're
lower.
it's 7.5 is our internal measure of
the sterling issue. Well, the fundamentally you can work around it anyway. If I wanted to go and buy a sterling denominated exchange traded fund that invested wholly in tracking the S&P, there's dozens of them out there, and it won't show up as a non-sterling denominated asset, even though fundamentally that money is tracking an American thing. So I don't really have a problem with it, because we're not hugely directly investing in buying individual, we're not necessarily rushing out to buy dozens of different individual US equities or whatever. There's a number of different ways of skinning a cat when it comes to that. So I don't have a huge worry on that. And then I forgot what the third question is. Oh, you take your money when you need your money. I mean, I think, in an ideal world, the best returns and the charts you see of people saying, well, here's a savings account and here's investing in the stock market over 50 years or something. Yeah, dividends reinvested, compounding and compounding and compounding. And it's the 8th wonder of the world, as Einstein said. But you can only compound if you don't need the money for anything else. And fundamentally, you guys have other priorities and other considerations to make. In terms of where you take the drawdowns, again, if you could see 10 years down the line about where your capital spending might be and so on, then you could say, well, we might leave some of the income to pile up so that when we need that drawdown.
We're potentially looking at that with that rather large spend in 5 or 6 years' time.
I do have a question about that. So standard, and the fact that the council obviously has plans. I think the only thing I would say is keep us posted. Keep us posted as early as possible, because it might be that if you end up with the year that both Charles and I, tentatively hope you might end up with, you may be in a position where even if you're not ready for the money yet, you're better taking some of it to skim it off a great year if you have one, then you are turning around and saying, can you send us X amount of money by the end of next quarter or something, and finding it's a pretty rotten time to
extract money.
So because you've got that sense of what's coming down the line, there's no ideal way to do it. The only way you'll know what the best way to do it was when you're looking in the rearview mirror.
So I think
you've got to make the best sort of the least bad decision possible, rather than trying to get the perfect decision.
Yeah, sure.
But yes, the further in advance. the
Yeah,
easier it's gonna be
is that
for
it?
all of us.
Yeah, well,
6 years possibly. So.
I don't know if Charles is.
Well, I can't disagree with anything that you've just said. I think that all makes perfect sense. And as you say, giving us as much warning as possible. Being a forced seller is not a sensible policy. But if we know in advance that you're likely to extract whatever amount, then we can try and provision and plan ahead and try and finesse.
Yeah, that's
time.
useful advice. Well, we do have a 5-year plan, which is something we haven't had before,
Mm.
on spending plans and our income projections.
Yeah.
And then maybe that is something we should share with them. We do have for example, a 1.5, potential 1.5 million spend on the building of the town hall, the infrastructure itself, over 10 years.
Yeah.
But the timing at which we do that,
Yes.
and some of it is work that we would need to synchronise, and therefore there may be one year where we do need to plan in a greater spend. So it all, once the scaffolding goes up, we have several pieces of work we want to do at once.
Are you about to ruin my view?
Well, I think temporarily.
The thing I would say.
Scaffolding everywhere.
The thing I would say, I think it's funny. The one thing I would say is that, on that subject is that the reason that more notice is better is partly because being a forced seller at a disadvantageous time is not always great, but it's also the knock-on impact because, so for example, Charles will have similar criteria. There'll be a maximum weighting in any one holding, a maximum weighting in any one collective, a maximum, internal controls from our point of view to make sure that no one goes off the reservation and bets it all on black. When you do a drawdown at relatively short notice, first of all, it may be a rotten time to do it, but also where we take that money from, the holding that was at 6% might actually become a holding that's worth 7.5% because the overall portfolio size has come down. So there's a lot of considerations in there about how we make sure, not just that we give you the money that you ask for on time, but that from the day we do it, straight away, your portfolio remains within the risk mandate and remains fit for purpose because we've got an obligation to you every day that the money's with us, not just to sort of steer it back on course like a slow-moving oil tank.
Well, that's useful to hear from you that you having a better understanding of our spending plans in the medium term is useful to know, so you can understand when selling is likely to be necessary, and as you say,
It's easier to
fire sales are not good. I mean, can I summarise the other answer you gave to the auditor's question, which is that there's no particular constraint that we've imposed on you, which is causing you to perhaps be less bring in less income than or growth than you would otherwise do if you were given the free hand.
I don't think so.
No. Yeah. I don't think so.
Yeah. Okay, that's useful. So, Michelle, if you want to.
Well, I just had a bit more of an observation where you talked a lot about inflation and that inflation coming down. But what I hear about a lot on in the news is that inflation is now baked in, that term, so those prices are not going to come down again. And certainly a lot of prices, like insurance, for instance, went up by 20–30% even. And so, your observations on consumer confidence, I mean, I don't know about all of you, but I just don't feel it yet. And I just wonder how that will kind of affect our UK market going forward.
One of the key things, I agree with you, I don't think anyone feels any better off, even if they've had a pay rise, and even if it is technically ahead of inflation, than the lower inflation numbers that we're starting to see. Because it's always absorbed by stuff costing more. The current forecasts are that the next energy cap will come down another 7 or 8%. But the big one is mortgages. The big one is the fact that if we end up with inflation at or near the 2% target, then that would sustain interest rates coming nigh on halving over a period of time. As soon as that happens, then the economic impact is because actually the single biggest thing for most people that's hit them isn't marginal rises in monthly grocery bills from month to month, or even the energy price shock. It's the cost of paying their mortgage when they came off fixed rate deals as an immediate wallop that clobbered them.
Mm.
And that knocks on into what people are paying the mortgages with now is the money they would have gone on a holiday with, they would have bought a car with, they would have done this with. Even if they're getting by, it's money they would have spent elsewhere in the economy. And so I think that the big one is mortgage rates, and it will make mortgage rates much more manageable. And people, I think, will probably rush to refinance, to get on a. I think that the prevalence of 5 and 10 year fixes will go up because people have been bitten by their experience of coming off relatively short fixes this time. And that will also take a lot of people who've basically been priced out of the first time buyer market by affordability and potentially start pulling them back into the housing market, which is a huge driver of the economy in the UK, because we've all, so much money tied up in it as a home ownership obsessed society.
Yeah. Okay, thank you.
Yeah, my fixed term is about to expire in November, and it will go up a lot. But I did very well because I fixed it 5 years ago. But that means the pain I'm going to get is all the greater.
5 years ago, my bank advised me not to take a 10-year fix at just over 2%.
Yeah,
Because they said, but you can get, a 2-year fix at 1.85 or something. I said, I don't care.
Yeah.
I'll take it, thanks.
I took
great
5
bank.
years. That's about 2.8. Yeah, but yeah, it's about to go up from 270 to 900. So that will cause a check to the people's finances. That's still happening. The question I was going to ask, you talked, Charles Pickett talked about this, the fact that you couldn't invest in certain markets because of our need for growth, a need for income rather than growth. And this is probably a stupid question, so try not. You can patronise me if you want, but if you invest for growth, can't you then dispose of some of the assets as income, then provide that as income? Is that not a viable strategy to allow you to enter those markets?
Well, this comes back, I think, to your third point, Lawrence. Yes, Lawrence is here. That's exactly the point I think Lawrence was making on his third point. If we had a total return rather than an income requirement of, I think, what are we going for in total? 120,000 combined. So
I think, well, it's going to be more than that this year, isn't it? I think. Who's got the figures in front of them?
It'll come in more than that, but again, the general gist being that there is an expectation that money will flow throughout the year as the income is drawn down.
Well, there's drawdowns which we do to fund capital projects, and then there's the regular money we get in order to sort of in order to balance the budget. It's as near to zero as we can get. So there's the two forms of income stream that we get from that. But it looks the same, I guess.
So the other way of looking at it is that we have a total return strategy, and we pay you, let's say, a fixed amount, which, for argument's sake, if we're producing £80,000 worth of natural income, rather than paying that out as it arises, we could pay you a fixed amount of 20,000 or whatever the figure is, not do the maths, or lots of 20,000, so that equates to 80,000, which could be a combination of income and capital growth, just as you say, and that arguably could get you better returns over time, because the rate of capital growth is invariably higher over time than the income generation. So it can work as a strategy, but there is always a danger when the reverse happens, of when markets are falling and you're expecting a fixed amount that then is coming partly from capital. You are then eating into your capital. So it works brilliantly when markets are rising, but it becomes much riskier when markets are falling.
Things are better in a rising market than a falling market. Who knew?
Statistically, capital's about 7, depending on which study you look at, something in the order of 7 times more volatile than income. So, fundamentally, if you have a year where the markets fall by 10%, the odds are, your income may fall by a seventh of that, or the number of years in which income falls heavily will happen 7 times as infrequently as the number of times where capital falls heavily. So the difficulty is for every year in which it's beneficial, what you need to weigh up is whether the joy that gives you will exceed the pain of the fact it will kick you twice as hard in the years where it doesn't work, because it will have been a year where you've effectively been paying us to hand you back some of your own money in a depreciating pot for the course of the year, and it will magnify the speed of descent of a portfolio in a bad year, which then means that the amount of mileage a portfolio has to recover in a good year to recover its position and make absolute returns is increased.
Yeah.
It's also not a total exclusion of the growth stocks. It's just about finding the balance between what generates the income and what gives the growth as well.
Yeah.
So for example, when I don't know what your decision process is like, but for us, if we've got a balanced objective, if we're sitting there and saying, right, we want to do something that's growth focused, we're also then looking at where we're taking that money from, if there's income coming out of the asset that we're selling out of, and then finding a way to regenerate the income while also incorporating the growth stock. So it's not that we're sitting there and saying it's absolute no-go, it's just trying to find that balance, because if it was capital growth only, we would be able to do certain things that we might not do in quite the same volume, if that makes
So
sense.
yeah, so I think what you're between you, your three of you, you're saying is that potentially it increases the risk.
Yes, it does.
And so
Yeah. So if you look at the first page of my presentation, the long run performance, so we can see that over this 12-year period, we've produced a return of 6.3% per annum. We know the current yield is 4.4, therefore by definition, we're getting about 2% of capital growth, and 4 and a bit % of it is the income flow, i.e. to meet your criteria of at least 60,000. And the fact that we're producing 80 is obviously beneficial to you, but we could tilt it so that we produce, let's say, 2.5% of income, and then try and produce 4 and a bit % of capital growth. But as we've explained, that is a riskier strategy. Great when markets are going up, not good when markets are going.
In all honesty, in all honesty, if you guys turned around and said, "Do you know what, forget the balance mandate, just invest. Our objective is growth, and we want to still be moderate towards the lower end of it, maybe, and so on." We'd still invest in things that pay dividends, because dividends fundamentally over any time frame make up a significant part, as Charles was saying, of the total return. So I don't think it doesn't have to be one or the other, and I don't think it should be one or the other.
okay.
Yeah.
I'm going to ask a second question. So I'm looking at the report on the investment return that's come from the officers, and in that over the last 12 months, and in that both of your portfolios have slightly underperformed the ARC steady growth. And it may be that you can't answer this question here about why that doesn't tie in with what's in your reports, where it was certainly Charles's figures compare with the ARC favourably, I think. So on the first page?
No, it doesn't have the past 12 months. No, it does say that I can't remember where, but to say over the past 12 months, that has been less. I can't remember.
I thought you'd slightly outperformed ARC according to your calculations, Charles.
Not in your financial year to March 24.
Okay, so that's the
We've
April tax, is it?
We've underperformed
Okay,
at the end of March. So we produced 6.9%, and the ARC steady growth was 9.2 in your financial year.
The figures I've got here is that you're sort of set on the rolling 12-month figures. Okay, right.
Now, of course, the ARC data, the people who submit their data to that analysis, they may not be constrained by not having oil and gas, mining, etc., etc. I'm afraid there is no analysis that we can compare apples with apples, I'm afraid.
Yeah, it was the comparison of comparisons.
Oh.
That was trying to be.
I think like all lies, damn lies and statistics, it's pick which period you're measuring it over, which is why,
Yeah.
for example, we've just gone for calendar years because they don't budget, they're not
Yeah,
subjective.
and as Charles said, at the start, that is what he was asked to do, but yeah, explain the difference is fine. Right, let's try to do, Mathilda, do you want to ask anything?
No, I'm okay. Sorry.
Rory, you?
I already asked questions last week.
Yeah.
With your leave, I'll put my crystal in the at BFM.
Yeah, okay, that's fine, yeah. So,
Just one question. So we're moving slightly up the risk, the investment risk profile from sort of low to medium.
A couple of years ago, you changed the mandate. It used to be that the mandate under which Charles operated was a moderate risk profile, and under which we operated was a cautious risk profile. And a couple of years ago, with the idea that somewhere between the two, you'd end up with a blend that felt right. And a couple of years ago, the mandate under which we operate was altered from cautious to moderate. Hence the significant change in the sorts of assets that we're holding over the periods mentioned on page 7, of the rise in equities and so on, as we've been bringing it into that. So it's not that you've broken new ground, it's just that you brought the two portfolios more into the same.
Okay. So my question was going to be, given that you're pretty sanguine about most risks, actually, current inflation, growth, employment, my question was going to be where do you see risk? What is perhaps the key risk that you see? And where would you see nudging our long-term performance to, given we're being a little bit more risk happy, risk positive?
It's very difficult to say, because the things, for example, that caused problems in 2022 and you know, perhaps less so for Charles, but more so for us in the initial parts of 2023, were the parts of a portfolio that shouldn't have been risky. You know, in 2022, the gilts market, which is where the widows and orphans are meant to be sent, fell by 24% or something. You know, once in a generation size fall from a no risk asset or a close to no risk asset. And all of the other interest rate sensitive things like infrastructure funds and so on that were meant to be relatively low volatility, low risk assets that tumbled on the back of it. So, you know, I think the difficulty is we all have to measure risk, and you guys have to say what risk you want it to be, and we have to find a way of measuring it and so on. And the reality is that it wears a different coat every time it creeps up and slaps you, because the thing you didn't think was going to be the problem is tomorrow's problem. In terms of your overall, do you want to, you know, sort of creep up the risk profile? If things start going this year as we envisaged, we may well use the leeway that we've got, having come from a cautious risk and we're now into the band of what we would call moderate risk. We've got some headway. We may use that a little bit more, but I certainly don't think you would necessarily want to try and sort of push for the top end of it and, you know, ride it hard on the, you know, the verges of medium high or anything like that. And I don't think there's any need. I mean, you know, as I say, we're getting more volatility than we'd hoped for out of things that weren't meant to be in conventional wisdom.
I think also my response would be that risk, yes, is measured by volatility, but it's also, I also view it as permanent loss of capital. That to me is a risk. So it's not just a measure of how much things go up and down, which I know is the conventional sense. And that's why it's very important that we focus on good quality assets that are sustainable over the long term and that increase over time their dividends. And that's how you get good long-term performance. So I would catch it in slightly different terms from the conventional definition of risk, which obviously, yes, is volatility. But it's the structure of the portfolio and there's the quality of those assets that's absolutely paramount in how we invest.
okay, let's try and draw this session to a close then. I'm going to try and briefly sort of summarize where I think we've got to, which is that you're in terms of delivering the service to us, you're there's no particular aspect of the brief we've given you which you suggest that we might consider changing, subject to your advice. The level of risk is something that we can always change if we want. That's really up to us. You can't tell us what level of risk we should be using, but you will interpret that in your own ways. In terms of what we're going to do is that the value for money committee that we have, which we may rename, it becomes a rather broader role than this. We have a working group which will look at whether there is any change that we might consider to our management of our investments, and we also might consider whether or not to go through a process of re-procurement of the. That is something that we need to consider whether that's a good idea and how we would do it if so. And that was something that we'll probably do in the next month or so when the next meeting of Value for Money committee is that we're all referred to a minute or two ago. So if you've got any, I think if council have got any questions about the presentation that's made, I'll go away and read them in more detail. And we can contact you with those questions if you don't mind. If you've got any points you didn't complete successfully or want to clarify, then feel free to come back to us and use that as input. And so we'll let you know. The one last thing was that it will clearly be potentially helpful for you to have a better idea of our medium-term spending plan. So we have a 5-year plan, which but it would in practice it would extend beyond that. We know there are spending commitments that we have that we will need to do, which will go beyond that. So we'll have to consider how to present that to you. It's currently has been approved. We are working to it, but obviously it's a living, changing document regularly. Yes. So I think it would be useful for us to consider how to get that to you. It's a fairly small spreadsheet.
Big plans.
I know the officers are smiling because I know they put a lot of work into it, and it's extremely useful and it's an important step for our financial planning. But engaging you with that would be useful. Yeah. Good. Anything else from anyone before we wrap this up? Okay, thanks very much for presenting. Welcome to stay for the meeting. It's a public meeting. If you want to hear about our risk,
It's tempting. Actually, I just want to say thank you very much to all of you, because you've been helping me a lot in the last couple of weeks for getting the numbers for the internal auditors. So thank you very much.
It was an absolute pleasure.
Okay, let's press on. Item number 7 minutes to approve the minutes of the 16th of April. Right? We are going to press on a bit now. I'd like to finish by 7 o'clock.
Bye.
So, can I put us on to the committee meeting minutes on the 16th of April? Yeah. We approve those. Plans. Seconder. All those in favour? Thank you. To note and approve any recommendation of 353, 357 working group. Kath, do you have something you want to say about that? Or
Yeah, just to clarify.
Jonathan, say.
The recommendation in these minutes is that we appoint a pitch contractor so that Elite Sports Turf have appointed a pitch works at Cleveland Park. There is a recommendation now on page 7 or a clarification subject to confirmation by the deputy clerk with TGMS, who are the consultants for the pitch works, who put the tender documents, and Elite Sports Turf have the need for Part C enhanced agronomic maintenance. This is a year's worth of maintenance of the pitches. There's a question mark over this because Elite Sports Turf actually carry out this work already for AFC Henley as part of their contract with AFC Henley for maintaining the pitches. But I haven't been able to clarify that with the agronomist because he's on holiday at the moment. But we have got enough budget already approved back in March last year to carry out the actual physical works to level out ground on Reading roadside and to remove a bund and reseed on the southern area of pitches. So I think this stands as a recommendation. If we do need more funds, to carry out Part C, enhanced agronomic maintenance, then I will come back to another committee in due course.
Okay, right. So we have the notes here with the recommendation. I have proposed that we receive the notes and approve the recommendation. Okay. All's in favour of that? Right, thank you. You can say words if you want, Ken. It's up to you.
Okay.
The Valley, to approve recommendations of the notes of the Value for Money Working Group of the 16th of April. Proposal for that? Yep. Okay. I'll second that. All in favour? Thank you. To receive the management accounts, bank reconciliation summary of payments. Are there any comments on that? Sorry.
I'm sure I do have the Alton report that I can speak to, which was only sent round today. So councillors may appreciate me going through it verbally, unless they've been able to read them up and inwardly digest it already.
You're going to go through it word by word.
If anyone's got to, I think we can receive the papers and note that that document. I think it's well worth reading and coming back with any questions. I mean, it's a very useful explanation. But I did notice that you managed to find about 209,000. I reckon by my calculation of.
But there are about 110,000 of positive.
Yes, that's right. We're hence the 100,000, approximately £100,000 deficit that we have. But yeah, I think would you like that to be deferred to the Value for Money meeting that we?
If
that seems that makes sense to me. So we consider it there. And anyone who's sort of on this committee but who's not on Value for Money is welcome to attend and contribute that meeting. It's not excluding any members of this committee. So I'll propose that we receive the accounts and reconciliation summary of payments and notes that we will discuss the report on the £100,000 variation from the budget for the year at Value for Money. So I'm happy to propose that.
I'll second.
Everyone happy with that? All
Yeah.
in favour? I did clarify one of the 2 points that you raised, and that we can discuss something else on the problem.
Thank you.
To approve the following items of expenditure, 8,750 for the water fountain as recommended by RNA. Are there any comments or thoughts on that, Councillor Hunt?
One small comment. I should have raised it in RNA, so apologies for raising it now instead. How are we going to, is there a way to prevent abuse, particularly by more boaters filling up large containers and therefore leading to excessive use of the water?
There are other, there's at least one other tap along the tow path, which is a normal tap. It would be difficult to use the water fountain to fill up a large container. It would be relatively difficult.
So the problem should self-manage.
Perfect.
That's the answer. Anything else on that? So all's in favour of approving the 8,750? Thank you. Up to 15,000 for silver and architectural fees to support the changing rooms for the new 3G pitch. You want to say anything about that, Carl?
Yes, I could just speak to that briefly.
Please do, yeah.
So rather counterintuitively, in order to provide adequate changing facilities for the 3G pitch, the Football Foundation require us to provide permanent changing facilities with standards that meet their requirements. So this is mostly to do with solid modesty walls. The 2 large change rooms we have down there just have a curtain at the moment, for example, and shower cubicles with doors on, not just curtains. But we also need the toilets. I think that would be the most expensive bit. We have to have freely accessible toilets from the car park that you don't have to go into any lobby for. So the plan is probably subject to consultation with an architect. Taking advice is that one of the changing rooms will get converted into having a male, female and accessible toilet with doors that front directly onto the car park. which would be a benefit. At the moment, I think children have to, users have to, just come and go into one of the changing rooms, which is obviously from a safeguarding point of view, not very desirable. Anyway, having looked at the works, having discussed it with a couple of builders before Christmas and looking at the work involved, it would seem beneficial to get professional advice on how best we can do these works at the lowest cost possible. And also to take it through the building regs process and get advice on tendering for builders, etc. So I have received, as emailed out earlier today, have received 2 quotes already, but I'm expecting 2 further quotes this week. But based on the most promising of the quotes that I've received so far, it seems that it's probably advisable to take out the management of the tender process and also the contract administration once a builder's been appointed and work's being carried out. So I can run a tendering process. We do that all the time. And then the contract administration, I think myself and the town sergeant would be fine to carry that out, and the estates manager has agreed that. But we'd also need some additional services, so structural engineer, the fees for applying for building regs, and also CDM advisor, so for health and safety aspects of the works. And then we need an architect to look at the works once they're carried out and sign them off, and also carry out snagging. So rather than the 15,000 that I asked for before having got any of this information from architects, etc., I think it would be wise to ask for up to 20,000. So this would basically work out at just over 13,000 for an architect, and then an additional sort of 5,000 or so for the other consultancy that we'll need, and building regulation fees. So the recommendation 5.1, and we have got sufficient still, according to Mercedes calculations last week, that so the council could allocate up to £20,000 from SIL for architecture and other professional services for changing room alterations.
Okay, and just to remind you that this money is needed in order to secure a viable bid for this approximately 700,000 that we're hoping to get as a grant for the 3G pitch. So you can regard it as a bit of a down payment, which is the positive way of looking at it.
Yeah.
But yeah, the 3G pitch is a great opportunity with that. It's something that we're highly committed to doing, and will be a great asset to the town and people who use sports facilities with it. So although it's 20,000, that's I'd rather not have to spend. It's we will be getting things back, which are significant. Yeah, that's plan.
Yeah, I recommend approval. It's a straightforward stepping stone as part of the wider project.
Yeah,
it's essential on that basis.
Yeah, I'm happy to second the proposal. Okay. Any other comments? All's in favour? Okay, thank you. Thank you, Kath. £714 for upgrades to electricity at Red Line Lawn. And I think it's a query from the mayor about this. And this is to cover the cost of the electricity. To be clear, is paid for by the leaseholder.
Yes, indeed. It is just for upgrading the electrical supply to provide a socket that can be used by moored boats to power them rather than having to run their engine, and also to upgrade it. We've had break-ins into the electrical box that was fitted. So this is basically to prevent break-ins by basically having an external socket, so people don't need to break into the box because they can just use the external socket.
Okay.
If this is an improvement for the sake of the leaseholder, why, given that they've just started their lease, why are they not paying for this cost themselves? And secondly, if people have vandalised the existing infrastructure, if we put external sockets in, how are we going to prevent them from vandalising those as well?
So they were vandalising the existing box in order to basically rip it open to make use of the power supply. Basically, it looks like people wanting to charge their phones. So it was replaced and it was broken into. So the view is that they're doing it for the reason to get the electricity supply. So if we can just give them ready access to the electricity supply for charging phones, which will not take much energy at all, then it should prevent further vandalism.
We'll have a camera down there looking on us and making sure that it's not being vandalised. But
I believe all of these 114 pounds.
This is only part of a much broader programme of works to improve the law, which you'll be glad to know will probably be coming to this committee for approval. soon.
is the leaseholder happy with paying all the electricity, even when it's
Yeah.
not in use by them?
Yes, the licensee knows that they're paying for the electricity, and it was partly their suggestion as well.
Okay.
About the excess one.
Okay, fine. Thank you. So that clarification. Right, the proposal that we do as requested here.
Definitely.
Okay, seconder. All in favour? Thank you. IT support contract. I confess I haven't had the chance to read the papers. I did ask to be part for them, and the size of this agenda has meant I haven't had a chance to look at that. Although from what I've seen, I have no specific concerns about the principle or any of the details that I had the chance to check. But I would, my inclination is to listen to whether other councils have had a chance to look at this and see whether or not we are in a position to give an informed agreement for what is quite an important part of what the town council needs in order to operate and function as a town council. Our IT is obviously critical to how we operate. Town clerk, can you
Sure. So
help me out here?
Yeah, so following some questions I've received, I sent round some clarifications. I think it was yesterday. I did send a link. So because we had 22 tenders and each of them is quite lengthy, hence they're not included on the agenda itself. But I did send a link so that you can view the individual tenders should you wish, as well as the invitation to tender, which gives all the contract specification. On the tender comparison, which is correct in the digital version, but didn't print out correctly on the hard copies. So you've got the A3 here gives more gives in full. The specifications, although the rough specification is down the left-hand side, so you can see the breakdown of the different costs, and the recommended preferred the recommended contractor that we scored that scored highest is contractor H. So you can see how those monthly costs break down. So for the IT support itself, the total cost is actually only £405 per month. So per year, we're talking about £4,800. So over the 3 years, the total cost of the IT support is in the region of 15,000 in total. Exactly. So the remainder of that is the basically software subscriptions that we have, which are increasingly playing a larger and larger proportion of the costs. So we're talking Microsoft 365 licenses predominantly, and email licenses. So that covers all of the staff and councillor licenses. There is a sum there for archiving. However, the view is that that monthly cost we could save on. It's a kind of belt and braces approach in case we lose the data that is stored on SharePoint. However, I think it's safe to assume that obviously Microsoft holds that data on many different servers throughout Europe, I believe. So it is pretty secure. So the view from a few of the tenderers was that actually you don't need the additional archiving on top, so that would be a monthly saving of 117. So that's I'm aware that obviously you haven't seen the details of all the 22 tenders, and I probably wouldn't expect all councillors to look at those tenders. It may be that you'd like to look at perhaps a couple of the highest scoring tenders at your leisure. The current contract comes to an end in mid-July, and we do need some time to manage the transition. If the committee isn't minded to approve the recommendations at this meeting, I would ask that there's some kind of delegated authority so that it could be delegated to myself, but in consultation with councillors, once any questions or queries have been resolved.
Yeah, that sounds a sensible compromise to me. So we can agree that while we've no concerns in principle with the recommendations we've made, which is to go with the highest scoring bidder, which is H, that running a check, councils have an opportunity to check against the scoring and the procurements that are made of certainly the most high scoring bidders. I think would be a good thing to do. So I'm happy to propose that we give you delegated power to make the final decision in consultation with the individual members of the committee.
I'm happy to second.
Yeah. Okay. I'll just say we should aim to do that in the next 2 weeks. I think. So is that a reasonable time frame?
That would be fine.
Yeah. Okay. Right. Is everyone happy with that proposal? Okay. Right. All in favour? Right, thank you. Right, so recommend full council to full. So yes, this is a recommendation to full council we're going to make, which is £50,000 of solar panels for the 2 buildings, the Pavilion and Brunner Hall. And, there's a good report from the officer, which 51, which I think goes into quite enough detail. This is the sort of project that is consistent with our declarations of emergencies, nature and climate. There's any points that they want to raise or questions regarding this. Again, I think you did raise a couple of questions, and there is a 10-year guarantee warranty for the panels.
10 years, absolutely fine. I still think that the return on investment 15% is optimistic, but even with a more pessimistic view, it's still worthwhile going ahead. So I would propose we accept.
Yes, it does presume, it does make an assumption about the electricity prices staying the same.
Yes, and as we heard,
They may go up, they might go down.
it's highly likely they will continue to go down, and that is exactly what the market expects as well. So I do think it's unlikely we will see a return on investment of 15%, but I think that it's a low. We will see it within 10 years. The warranty is 10 years, so I think it's worthwhile going ahead.
50% is a pretty good return. It's more than we were talking about with the investment managers. Sorry.
That's exactly what I was going to say. I think of the benchmark to put against it. What is if invested in our investment portfolio, what is the return that we would otherwise be seeing?
Exactly.
And I think that even if it still goes down, then it should still be on par or greater than the return otherwise. Yeah.
What section of that very unusual roof will it go on? I mean, it's a puzzle, isn't it?
Well, you can't make the building more ugly. Can you? It's seamless.
I'll be referring to the pavilion.
Yeah.
I believe it's on 3 of the. So it's basically almost all of the south, more southerly facing aspects. There's one where it can't go on because there is no roof because it's outdoor space. But otherwise, I think it's 3 of the 4 sides of the south facing part of Oxford.
Yeah, no, there was a proposal 12 years ago that I managed to put forward to this committee, and it was rejected. I was outvoted. So this is I've been waiting 12 years, so I'm certainly going to vote in favour of it. It's the right thing for us to do, and it's a good report, and I'd like to congratulate the officer on getting this gave this proposal into onto this committee. Okay,
Mm.
so I propose therefore that we go ahead with this.
Yeah, it's been a
As a
thorough
recommendation.
process, so.
We've got a second to that? Okay, Councillor Hunt, all those in favour? Thank you. Item 10, policies, strategic risk assessment. Now, again, I have trouble finding time to read it. I did actually look through it today. I did have a couple of comments. Right on page, the page I'm still in trouble with. I think it's page 5 of 9 is the which I think is 50.
58.
58, right. Libel and slight. I do believe that councillors, when speaking as councillors, do speak with qualified privilege. So we do have case law which protects us from libel and slander accusations. So I think that's that is worth noting.
I believe that is there in the controls, code of conduct and qualified privilege.
Oh, come on, it is a well, yes, there is a there is a couple of those. And on page 7, the 5-year forecast. This is what we talk about that we're reviewing in Valley for Money. I wasn't sure how we call it a 5-year forecast, don't we, as opposed to a plan or a budget or
Oh, it's the 5-year financial forecast. That I was referring to.
Yeah.
But equally, the 5-year strategic plan.
So the strategic plan's mentioned in the next column along.
Mhm.
Under IT failure on top of page 8, we encrypt the town council devices, don't we?
Yes.
So that is a form of protection that's against lost devices and stolen devices.
They used to be encrypted.
We did pay for that service initially, but when I was signing off the IT.
They used to be encrypted. However, I believe that encryption is no longer there. I don't think it's, it was removed as being unnecessary. I think probably about, maybe not a year ago, but quite a few months ago. There was our IT support did provide very good reason, but I can't remember the exact reason.
Windows provides its own form of encryption. You can encrypt the disks, which we should be doing.
So there's so yes, it's all password protected. So yes, when you log in, you do need to log in. So there's that. But there was an additional layer of encryption.
There was for tablets and phones, I think.
So there's there's an additional layer of encryption for laptops, which isn't there now. So I think it is relying on the Windows level.
Which is sufficient as long as it's done.
Yes.
Okay. I think all the comments I need to make. Anyone else have any comments? We would like to get this through tonight because you would like the auditor to have this when they're starting workshop. Is that right?
Yes, indeed. So we should have it done before the audit. Apologies, I should have had track changes on there so you could quickly see what the changes are. I mean, there isn't really anything particularly material, no material differences in there, but I can go through and quickly summarize what the changes are, if that would be useful to them.
Very briefly. It is quite an important document about for us to make sure that we're happy with.
So on page 5, under lack of ownership of tasks, so I've said that so all these are under actions, which is the second column from the right. So the last bullet point, ownership of key projects, is identified in the strategic plan. That was added. Acting ultra-virus, it was the last bullet point under actions. It's the town clerk receiving ongoing CPD. And that's a slight amendment from last time when it mentioned that I was doing a degree course, which I've now finished. Under libel and slander, then under controls, we've added in the last bullet point, which is that there's communications manager in place to monitor these things. Under natural events, we said that now under bullet points under the actions, so all applications are now cloud-based. We're moving to a VoIP telephone system, and we're having revaluation regalia of fine art that's being undertaken shortly. Under security of buildings, the last bullet points under actions is that there's an environmental visual audit has been undertaken by SADC Red Lion Lawn, which relates to the previous discussion around the electricity and other security measures such as CCTV, and we're just waiting on those recommendations to come through. There is under inadequate upkeep of buildings assets that was mentioned. The last bullet point, which talks about major works are now included in the strategic plan, that's been added in there. At the bottom of that page, so page 7, over reliance on contractors, we've added in that procurement training for SMT has been completed, and we now have a procurement specialist that we get advice from for all the more major kind of procurement tasks that we have. Under IT failure, so this is top of page 8 or page 61. Just an added bullet point to say that the IT contractor is being reviewed as we've done this evening. On the over-reliance on investment income, which is page 8 of 61, so the same one. We've added in an annual review of the investment portfolio, which will be included in the value for money. And I think the last one you will be glad to know is under lack of general reserves, which is bottom of page 8 and top of page 9. There's the bullet point to say that that we have created the 5-year financial forecast, which is going to be regularly reviewed by value for money. And that's it.
Yeah, right, thank you. Okay, so I'm happy to propose. Yeah, okay, I'll second that. Okay, all those in favour?
Like talk them into submission.
We're convinced. Pensions discretionary policy. This hasn't changed, I think, so we'll simply continue.
I have nothing to add.
Yes.
Re-adopt.
Yeah, I have to second that we re-adopt. I would like to add in that our pensions are held through the Oxfordshire County Council, and I'd like to write to them and ask them what policy they have on ethical investments as part of their pensions. It's consistent with our climate emergency and the nature of emergencies that we should be trying to invest ethically, which effectively what pensions are, an investment. So I'd like to re-adopt, but write to the county council asking for whether or not they do have a policy on an ESG index or other ethical criteria.
I'm happy with that.
Okay, was it? All's in happy? All's in favour? Okay, thank you. Working group membership. 353357 Reading Road Working Group. I'd like to propose that the existing members are reappointed. You happy with that, Rose? Michelle? Okay. I think the number 3 is working. The 3 was on there, so especially the guidance of skills and experience of Kath, who's been longest for some time there. We are very lucky to have Kath working so effectively on this. So that membership, I propose that. Was in favour. And the Value for Money Working Group, I'm still not convinced the name's right. So new names alternative names are welcome, but we sort of know what we mean. And we have terms of reference, and I would just like to amend those so that it says that it meets as needed or from time to time. And let's change that to, but it should be quarterly. Okay, so all in favour of that? Okay, thank you. Exclusion of public and press. I propose that we exclude public and press. We're going to turn off the camera. Public bodies according to Meetings Act 1960 is publicity will be prejudicial to the public interest.